Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. But today we're going to dive into Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go. It's most likely going to be related to three topics: wealth building, financial topics, and/or commodities slash precious metals. Those are the topics that I generally cover. All right, so let's dive in. Let's see what people are talking about. And if you want to follow me, it's at finding_finance. And if you want to join our community, finding-value.com. We got a Discord channel there that you can interact with other members. I go on it as well and share my opinions and what I am doing. So Christopher Aaron says the update, the single most important chart in all of finance, the Dow to gold ratio, which way will it break in 2024? And I don't know if that's the single most important chart of all of finance, but at least that's what he thinks. Dow to gold ratio. I think it's going to break to the downside. I think that the valuations, the only way they could break this thing to the upside, I guess, is if they were to somehow flood the system and use the money that they flooded the system with and directed it towards stocks. I guess you could push it that way. But the market conditions in expansion phase of real estate, those generally are favorable for gold, precious metals. Increasing inflation and increasing interest rates is, I think, what's going to come in a little bit. We need to get the housing market back going. I think that's what Powell's probably going to try to do. Lower rates, get it moving again, and then we'll get another move on up. Now, short term, when rates generally go down, gold does very well under those types of market conditions, unless you've got an FOMC meeting where they dive bomb gold and silver, either before it or after it, to ensure that gold cannot go up during the FOMC meeting or after it. But I think we're going to head lower, where gold outperforms. Metal inventories, we have a problem. Copper, nickel, lead, tin, aluminum. The London Metal Exchange base metal inventories. These are all of them stacked on top of each other. Obviously, we had a pretty good large move in inventory in 2008 or 9 when everything slowed down. And then look at where we are today. My Lord, this is, I think, the lowest it's been going back all the way back here. I mean, this thing is ultra low. And yeah, we've got a problem, guys. This is going to end up being inflationary. And this is how it's going to be inflationary. They're going to create credit, or the market's going to create credit through new loans against the real estate market. This here needs to keep everything in balance. You have to have these inventory levels to draw on to keep the GDP high. So in order to balance the market out, if credit gets created, GDP needs to get created along with it. But if you have supply shortages of whatever it is, oil, nat gas, base metals, these are the feedstock for everything that we use to build. So if you've got shortages there, like let's say they're pretty chronic shortages, which I think we've got pretty chronic shortages in a lot of different things, it's going to create inflation where credit expands faster than GDP, which AKA is inflation. And if you've got supply problems, it's going to amplify that inflation. Wow, global onshore crude oil inventories. Look where we're at, guys. How is this possible? And I didn't realize the FOMC meeting, and they were just dive bombing everything left and right. They dive bombed crude oil. They dive bombed gold, silver. They're hitting all sorts of stuff. They dive bomb the whole market. But look at where inventory levels are at. If oil stays at this price and we continue to eat through inventory levels, what are we going to do? See shortages at some point? And I don't think we're at that critical level, but we could continue to draw. And it's getting very interesting. I don't know if we've been at pricing where we're at today with total inventory in SPR and commercial inventories at these levels. I don't think we've ever had oil prices this cheap and be that low in I'll call it total inventory levels. We should probably be quite a bit higher, I would say, trying to put inventory back into the Strategic Petroleum Reserve, but they can't, because if they did it in any sort of quantity, they would continue to draw down inventory. And here's the pricing, and this is my justification of it. Comparative inventory analysis on EIA data for 131.24. Total commercial petroleum stocks are down 9.6 million barrels of oil equivalent. Wow. 9-month low. Lowest reading since April of 23. Calculated WTI fair value of $80 or $3 to $4 undervalued, given where we are inventory wise. Now, this is just commercial stock inventory. This is not with Strategic Petroleum Reserve or any of that stuff worldwide. It's just commercial. And we're undervalued by $3 or $4 a barrel. Soft landing in the stock market, hard landing in white collar jobs market, no landing in the housing market. It says many landings. What about crash landing? I don't see a crash landing anywhere. But I guess I don't know if you guys watch Formula One, but I know the first couple of years Max Verstappen was racing. That was definitely a crash happen. Max Crash Happen was his name, and that's where I was just reading this and it popped in my head. Coming down, you'd never believe why home builders are anticipating a decline in housing starts in 2024, and this is up in Canada. So let's take a look, and I'm going to read a little bit of the quotes that these guys have for home builder pessimism. So I'm just going to read the quotes. Freeland told an audience in Ottawa on January 29th that the feds are aiming to unlock billions in new financing to build more homes faster. What we're doing is making the math work for builders, creating incentives for them to build more homes that would otherwise not move forward to construction. Financing that's principally construction financing for apartments and rentals is good. We do need more rental units. High interest rates, however, have priced out potential home buyers. So what do they say there? Immediate results, and would be at no cost to government, would be stimulate housing activity. Introduce 30-year amortizations for insured mortgages on new construction homes and lower the mortgage stress test qualifying rate in general, and still more so for longer 7 and 10-year term mortgages. So basically lower the stress test. That's what they say. The takeaway is that interest rates are directly lowering the feasibility of building much needed new housing supply. We see this in 2023, and it will continue in 2024. The 2022 federal budget set a target of building 5.8 million homes over the next decade. That's 3.5 million more than we normally would build. Yet total housing starts have fallen in 2 consecutive years, thanks to high interest rates and insufficient policy response. Well, if they actually build that many homes, it's going to be highly inflationary. It's credit expansion. So they're trying to build homes, but nobody can afford it at current interest rates. That's the problem. Now, here's another problem. As inflation gets into the system, it's going to put the cost of homes, it's going to push the cost to build homes higher. So if you have higher home costs and you've got interest rates that are still high, affordability is going to be absolutely horrible. I mean, are we going to get to a point where we literally cannot build homes at certain price points at all, like altogether, where the low end of the market just gets decimated and we just don't have any homes in the low end of the market because no one can afford it? I don't know. Crude oil with another rejection at its 200-day moving average. This is proving to be extremely difficult resistance to break through. There we are right there trying to break through this resistance line. Fair value is $80 given where inventory levels are at commercial inventory. So I am bullish, and I think inventories will continue to draw, and I can't wait to see where inventory levels are at for this summer. I'm very curious. And the BTFP expires March 11th, but don't worry, there's always the discount window, which works great for Silicon Valley. So this is the U.S. regional bank stocks today. We've got New York Community Bank down 37%. Valley National Bank down 6. Harbor One -4, a bunch that were down today. So this comes after New York Community Bank, which acquired the collapsed Signature Bank, cut their dividend by 70%. They always posted a quarterly loss of $260 million, while a $250 million gain was expected. Did regional banks ever really recover? Do we still have a banking crisis going on? -37%, really? I don't know. Maybe there's some banks out there that still need to get bailed out or something like that. Performance of the metals in January of 2024, the leader is uranium. We've got lead, and then we've got crude oil up 5.29% for the month. Looking at the bottom end of it, we've got natural gas, palladium, coal, platinum, zinc, iron, silver, aluminum. Those are the underperformers. And that's actually where I'm looking. I'm actually looking in these areas to see when we could potentially bottom and rotate up. I think crude oil will continue to go higher. I think uranium will continue to go higher. I think all these are going to go higher, in all honesty. I'm still a commodity bull. The only thing that could stop this is if we get a slowdown in the overall market and we see yields dive. That is when I would start to really worry. And is it warranted? I mean, could we get a slowdown in the regional banks that we were just looking at up here? It's definitely possible. I mean, something over here could scare and fear, get the fear in the markets going where everything sells off. It's possible. Yesterday, I heard gold is dying. It says, instead, here is the metal currently on the verge of making new highs in 6 different fiat currencies. Let us not forget that central banks acquired more gold in 2023 than any other year in the last 5 decades. Wait until 60-40 portfolios follow suit, as they typically do. So here's gold in euro, all-time highs. Gold in British pound, all-time highs. Gold in Chinese yuan, all-time highs. Australian dollar, Japanese yen, and Korean won. The only one that's really holding up is the dollar. And that's where we haven't hit all-time highs, and we're real close. So it's just a matter of time, in my opinion. Just a matter of time. Coming down, here we go. Why is it time to short stocks? And this is the U.S. Treasuries versus high-yield bonds. And this is the ratio here turning on up. And then we've got XLP, consumer staples, versus the S&P 500 turning up. Is it a time to short stocks like, the S&P 500? Maybe. I'm not going to short anything. They're just going to print a bunch of money and probably inflate it all up. So I'm not trying to do that. Oil market, another month of huge upward revisions to U.S. oil demand data. It's now total consumption in November at 20.71 million barrels per day, 910,000 barrels per day above the estimate using weekly data of 19.8 million barrels per day. Gasoline and diesel demand account for about half of the upward revision. So demand continues to get revised upward at the same time that our inventory levels continue to draw down. A great setup for oil. We'll see if we get follow through on oil. Peter Schiff says, Powell spoke about goods inflation and housing inflation. There's no such thing as either. Prices don't inflate. They rise as a result of inflation. Economic growth actually pushes prices down. It's inflation that pushes them up. All inflation is caused by the Fed and the government. And that's that fiscal spending. But I will say this too. Inflation is also created through monetary inflation, which is loaning in the system. There's also that. So he's got the fiscal side of it, the monetary side, which is the credit expansion against the new home builds. That's monetary. Fabi says this one of the many potential uranium catalysts ahead, and she's got a whole spreadsheet of all these different catalysts. One of the catalysts that I'll say is lower interest rates will spur a credit expansion. Credit coming into this system will push uranium prices and a bunch of commodity prices higher. That's probably not on the list when I was looking at it. The problem with the economy is there isn't a problem, says Bianco Research. My biggest concern is too much growth and sticky inflation, which would put upward pressure on interest rates. That is Jim Bianco's opinion there. U.S. commercial inventories hit a 6-month low relative to a normal baseline average. It's still bullish. So this is U.S. crude oil inventory deficit to the 4-year average. So you can see the deficits here, the large increase with the shutdown in the economy. And then we've basically been running deficits the entire time. The only time we didn't run a deficit was that shutdown. So we've got some monster deficits that are occurring in the oil market. Will those deficits continue to occur out in the future? I would think so. I think so. I think we've got pretty strong demand. Here is the platinum to gold ratio. That's a 22-year perfect bullish falling wedge. Even before I called the commodities bear market low back in 2020, I said platinum will outperform gold and silver in the coming bull. I hope that is right, guys. I want silver and platinum to do well. That's where I'm positioned. It says if gold is a 7x from here, imagine where platinum will be. And basically what this is saying is that platinum could outperform gold by basically a 5x. So it'd be 5 times 7, which would be 35 times. Could platinum get to $30-something thousand an ounce? It's possible. And I'm positioned for that to occur, hopefully. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And hopefully you guys are enjoying this information as much as I am. I like looking at other people's opinions, other people's charts, and making comments on them. All right, guys. That's all I've got. We'll catch you next time. This is Finding Value.